Well, good morning, everyone. It looks like we still have some folks trickling in, but I want to give us as much time as possible for your questions at the end. So I think we'll go ahead and get started. I want to welcome you all to the Child Care Relief Funds 101, all your questions answered. This presentation is in partnership with the Early Learning Alliance of Tarrant County, Child Care Associates, Child Care Group, and the North Texas Early Education Alliance, also in collaboration with your local workforce boards. So I am Bethany Edwards, Director of the Early Learning Alliance located in Fort Worth, Texas. This presentation will provide an overview of the Child Care Relief Fund, what you need to know, how to apply, and also some space for you to ask questions. Our hope is that every eligible program has the information they need to apply if they want to. So let's first do a little bit of housekeeping. Everyone will be muted during this webinar. Please use the chat function to ask any questions you have, and we will try to answer your questions during this presentation. I am joined by Melanie Rubin of the North Texas Early Education Alliance, and she will be able to help us manage that chat function as your questions come in. If for some reason we are unable to answer your question this morning, we will provide information for who you can follow up later on for any follow-up assistance or specific questions you have. Also, just wanted to mention that this presentation will be recorded. So if you miss any information, you can definitely go back and view the webinar whenever you need at your leisure. So without further ado, I would like to introduce our presenter, Gary Romano of Civitas Strategies Early Start. Gary, welcome. And if you would like to do a quick introduction of who you are and who Civitas is, and then let's just go ahead and get started.
Awesome. Gary Romano, President and CEO of Civitas Strategies Early Start. We are an organization that's focused on mission-driven businesses and enterprises, and we help them to increase their impact. And we've worked in a number of different areas. Early learning is one of them that we've worked in throughout our 12 years, and I have worked in personally longer than that. And in particular, most recently, going back to March 2020, we've been helping a variety of providers, both centers and home-based providers throughout the nation, access stimulus funding. And so we are currently working with TWC, Texas Workforce Commission, to support some of their efforts statewide around business coaching and helping childcare businesses to access the supports and the resources they need to get back in business and supporting the economy. And so what I'm going to be talking about today is actually a few things. So 3 different funding programs. We're going to talk about the Child Care Relief Fund. I'm also going to talk about FFCRA leave, the ERTC, as well as ways that you can get help, as Bethany mentioned. So, Child Care Relief Fund. I know a lot of you know about it, just in case, right? Let's talk about what it is. This is a stimulus program that comes down from the federal government. It's being distributed and administered by TWC. And it provides funds to help childcare businesses in their recovery. So this is a reimbursement program. So it is reimbursing you for costs that you actually had between January 1 and August 31. You can draw, and we'll talk about this a little bit in a minute, anticipated costs as we start looking to August. I know we haven't hit August yet. So, but it is about reimbursement. So it's actually replacing money that you've spent on actual costs, right, to help you recover and make those investments. The eligibility is for any provider, right? As long as you are licensed and registered by May 1, you had to have been open by June 18th. If you have a summer closure or like a temporary 1 or 2 week closure because of COVID, you're good to go. You also cannot be on the corrective action or adverse action list. And I know very few of you are, but those are the key criteria around eligibility. The funding is by formula, right? And so let me anticipate a couple of questions there that I know we've heard. One is, this is a set aside. So this is not like, don't panic. This is not a first come, first serve. You have till the end of the month to apply if you're eligible, right? And you can withdraw funds up to the end of August. And that money is set aside. So if Melanie has $10,000 assigned to her by this formula, she has $10,000. Doesn't make a difference if Bethany gets in 3 weeks ahead of her and requests her funds. Melanie still has her set aside. This is based on 80% of your license capacity at the 75th percentile. That's the primary driver of that allocation. Additionally, if you're in a zip code that's been identified as childcare desert, so those zip codes where there are fewer providers, we want to make sure that every single provider makes it through in those zip codes. They get additional funding, as do Texas Rising Star or national accredited centers or home-based providers. There is, and I'll get to it, I'm going to give you a website. There's actually a calculator up there. So if you want to look it up, you can do it on a calculator. If that's overwhelming to you, spoiler alert, we're going to give you an email that you can reach out to our team with, and you could just send us your operation number and we can look that up for you. So, but it is totally based on formula. It's set aside for you. Now, how do you apply for the relief fund? One, we recommend you prepare first. So as I mentioned, this is a reimbursement program. So what we strongly recommend is start thinking about those costs before you even get in the system, right? Start identifying what is going to be your proof of payment. How do you document this? If you have questions, you can ask us. The variety of things that you can apply for is extremely broad, right? Just to be clear, TWC, and I was on a call actually in another state that will remain nameless yesterday, and they were talking about how constrained their funds are, and I'll name it, New Jersey. And they're talking about how constrained their funds were and what they could use them on. And here in Texas, in contrast, I was sharing on how broadly the state is allowing you to use the funds. So in general, of course, it's got to be something that's related to providing care for the children you serve, right? And also it cannot be something that's a structural change, right? Like, so if you want to remodel that classroom and knock down walls and stuff, you can't do that. You want to expand your house, let's say you're a home-based provider, you can't do that. But there's a lot of stuff in between that you can. So much so that I'm not going to bore you with the long list. I'm going to give you a website. I'm going to give you some information on how you could find out the specifics, but no, it's really broad. The key is making sure you have that documentation. And if you want to use it for upcoming expenses, that's fine too. We recommend you just try to plot those out, right? So if I'm going to use it for payroll, let's say in August, should probably estimate how much that's going to use up. So I don't go through August and then get stuck scrambling to try to find some other receipts, which is okay, right? You want to make sure every dollar is covered, but it doesn't all have to be covered at the moment you apply. You're going to apply online. You apply online, it's already open. If you haven't gotten an invitation, your invitation is a unique link that you're going to get from TWC. It comes from a TWC address. There's been at least 4, and by the end of today, 5 of them that have been sent out since June 11th. They're only good for a week, right? So if you need another one, let us know. But you're going to want to look. If you're not sure if you're eligible, I'm going to give you an email address where you can email us and ask. But next step, apply online. You want to get that application in by July 31st. Once you get the application in, you're going to get a DocuSign that comes back to you, right? That says, you agree to the terms of the program. And then once that DocuSign is in, TWC reviews everything. You will finally get approved. There'll be a little link there that says request funds. And literally the window is just one thing. You don't have to upload your receipts at first. I'll talk about what happens with those in a minute. You just put in a number. Pro tip, just put the number in as numbers, no $sign, no comma. I know it's counterintuitive, but like if you had $10,000, you wouldn't put $10, comma, 000.00. You just put 10000. That's it. You hit the request. Once that request is in, within 21 days, you'll get a check. I do know a lot of people say, can we do an electronic transfer? Unfortunately, you cannot. There was sadly a lot of fraud throughout the stimulus nationally. And so TWC is taking a lot of measures to make sure that this funding ends up in your hands, childcare providers, and not somewhere else where it really should not be. So there are a number of steps in here, which I know may be kind of awkward at times, like oh, paper check. But that's to make sure that we don't accidentally get an application from Bethany and then we send it to her. And then Melanie comes to us and says, where's our money? And we say, oh, we sent it to this address, or we did an electronic transfer to Bethany. And then we find out she's in the Ukraine somewhere. So, so you request those funds, you've got your check, right? Now what, right? You've received that funding. The check arrives, that's the final step. The other thing that you're going to be asked to do is that step one, all that proof of payment you had, you need to hold on to it for 3 years. And you need to because TWC can and will be doing some monitoring. So they will be meeting with some providers just to make sure that everything was squared away. Do know if that happens, TWC has talked about some support that would be available to you to help prepare for that. So it's not going to just be you and the auditor, you know, mano a mano trying to figure this out, but rather, you know, TWC wants you to get through this, but they want to make sure that everything's squared away and everyone feels good about the results and how the money was spent. So next funding opportunity we want to talk to you about. And by the way, the next two funding opportunities I'm going to talk about are ones where you're going to hear me reference both 2020 as well as 2021. And both these opportunities can be retroactively applied. I want to say that up front so that you, because sometimes people tune out and say, it's not 2020 anymore. Why is he talking about that? I'm talking about it because if this applies to you, you can go back in time and get it. The other thing I want to caveat this with is, this is some of what we are here to help with. So as you hear these things, if you glaze over a little bit or feel a little bit overwhelmed, we're here to help on these things. Part of what TWC has engaged us to do. So know that you're not alone, but I want to make sure you hear about these two because these are two that normally aren't heard about by providers and aren't being taken advantage of in the childcare industry nearly as much as they should. So that lengthy preamble, let me go into them. The first one is the Families First Coronavirus Relief Act leave. This leave was set up way back in 2020, and it's supposed to help small businesses. So the federal government knew people were going to need a lot of time off. You're going to need time off if you got sick. You're going to need time off if you had to quarantine, right? So, you know, knock on wood, you didn't get sick, but, you know, you had to, you know, stop work and be out of the office, be out of your center in order to stay healthy and ensure your family was safe. We also know that at times, you know, where the federal government knew that at times you might need to care for a family member, a loved one who was sick, or, and I know this is gonna be a shocker to you, many kids were home during the pandemic because of remote school or because childcare centers were closed. And then that was another place where paid leave was gonna be needed. And yet small organizations, those defined as being under 500 employees down to just one. So if you're a sole proprietor, you're that home-based provider who's just you keep listening, this applies to you. What they said was for these organizations that are small businesses, let's offer a way to pay for that time off. And so again, this is for time off related to COVID, illness, quarantine, family care, or home care and school. And it runs from March 15th, 2020 to today and continues through the end of the calendar year. So this is something that's still going to be with us. So what's the benefit? This is one of the most complicated parts, right? There's two separate ways that we categorize the benefit. If it's quarantine or illness, if you had to quarantine or you had illness, you get up to $511 per day. It's based on how much you're actually paid, right? That's how much you would get back. If you had to care for a relative, a loved one with COVID, let's say your spouse got COVID and you needed time off to take care of him or her, it would be 2/3 pay up to $200. So if you made, let's say $500 and you had to quarantine, well, $500 a day, you'd get all of that. If you made $500 and you had to take care of your spouse who was ill, you would only get up to $200, right? So here's the other complicated part. You get 10 days, 10 working days from March 2020 to March 21. That year, you get 10 of them that you can attribute to this program. From April 21 to present, you get another 10. So it's just like if you had 2 weeks of sick leave. Think of it that way. You had 2 weeks of sick leave until March 21, and then 2 weeks from April 1, 2021 to today. The other opportunity is caring for a child out of school. So it has to be closed when it's regularly open. So this could be a little tricky, right? So unfortunately, this is not weather related, right? It has to be COVID related. It can be that the school was open, let's say you had 2 cohorts and your child was, cohort B and home Thursdays and Fridays. You can just use Thursday and Friday, right? You had to be not working, taking care of that child when they were out of school, and it would normally have been open. This again is 2/3 of your pay, up to $200 a day. It is up to 10 weeks. So that's 50 days worth. Again, it can be used intermittently. So we had a provider who, was splitting remote school with other family members. Her day was Friday, so she had to be closed on Fridays. So she was able to get those Fridays, right? You can see where this could add up pretty quickly, especially with the amount of remote school that a lot of people had to undertake during the pandemic. And again, this is split, right, between March 2021 and today. So we talked about the opportunity, right? Now, what do you do? How do you do this? First thing you want to do is document your time and rate, right? And by the way, we have a guide for this on the website I'm going to share, and we can also help you with it. So for some of you, if you have like W-2 employees, right, this may be very easy for you to document, right? Because you know what Melanie's hourly wage is, and 8 hours because she was off times that hourly wage would give you the daily rate, right? And the days she was out. It's a little bit trickier for sole proprietors. You have to divide your line 3 from your taxes, from your Schedule C, which is your gross wages, by 266, I believe. I don't know why I'm not remembering that number. It's total number of working days in the year. Again, it's in the guide. And that's your daily rate, right? So now you can take the days you were off, just want to create, and we have a simple form online for you for this. If you want the help, this could be a spreadsheet, it could be whatever. For those of you who are using a payroll system, by all means, ADP, others have Gusto, Paychex, all have systems for accruing this time, and you can do it. And by the way, this could be individually, or this could be in total. So for example, let's say back in November, you had to shut down your center for 2 weeks because you had to quarantine. Well, you can use those 2 weeks, the entire staff if need be, right? Because you had to close because of COVID and quarantine. So you can see where it can help on an individual level, but it can also help you with some of these larger events that happened. So you've now documented it, right? You've got all your ducks in a row, you know what your rates are, when it was. Now what do? You have to alert the IRS. Second trickiest part of this whole thing. There are 2 ways to do it. That's where it gets tricky. If you are a sole proprietor, you're not a W-2 employee, this gets done in your taxes. So when you go to do your annual taxes, you document and you share how much of this credit you should get. If you use online software, very typically, and we just did this with a provider in Texas, oh my gosh, earlier this week, it's been a long week, where she's going back into her online software, there's like a little amendment button, she hits, change, update my taxes, and then she reports this credit. So you can do it for 2020, it's not too late. Even if your taxes are in, you can request it. And it comes back to you, by the way, just like any other refund. Similarly, if you hold on to this information till the end of the calendar year, right? If you have some of this 2021 time, you can just do it as part of your tax preparation, hand it to your tax professional, do it online. And this is a credit, fully refundable credit is what they call it. So it's the same as if you paid into it, right? So think of this like the earned income tax credit, if you will, for some of you who might be familiar, right? Where if you get $5,000 in this credit, whatever isn't used to pay your taxes, you get back in a refund check. If you're a W-2 employer, in some ways it's even easier. what you would do is you would alert your payroll company, and they would add it to your 941, which is your quarterly reporting to the federal government on your employee costs and taxes. And if you have to do it historically, you can do a 941X is what they call, which is an amendment to your 941. In fact, right before this call, I was looking at somebody's 941X for the next program we're going to talk about, but it's the same form. It's very simple to do. And again, by the way, as I just alluded to, these are things we can help you with as well. And then you receive the money. Whether you do it through, no, go ahead, Melanie.
Gretchen just asked a great question. Does this apply to nonprofits as well? And how does this impact nonprofits?
It applies to any organization or individual business from 1 person to 500. So if you're a nonprofit, if you're a for-profit, it applies. If you're an individual sole proprietor, this is for you too. By the way, if you're a 1099 contractor, this applies to you as well. So it's really versatile. So if you're a nonprofit, in fact, 2 weeks ago, we were doing this with a nonprofit in Texas, and actually in North Texas, now that I think about it. So it absolutely does. It's a great question. And by the way, the next one we're going to talk about, that's one of the early questions I get, is we're going to talk about the employee retention tax credit. Does that apply to nonprofits? It does as well. So you're a nonprofit, you're good to go. And you know, because as a nonprofit, you're still doing 941. You're still paying payroll taxes, right? You have to pay Social Security and FICA and all that good stuff. That's the mechanism that's used for this money. And then in the end, what you do is you receive the money. If you do this through your 1040, your sole proprietor, let's say you file that amendment. We had a provider who did it not that long ago who received $1,500 from it. Or Melanie, to your point, you're a nonprofit and you use through your 941 filing, you get the same check in the end, one of those little rainbow colored IRS checks. It's a refund check. This is not like PPP where you have to do forgiveness or anything else. It's just your money to keep and treasure. So one last program, and then we're going to talk through this one, then we'll open up, we'll answer some questions. The employee retention tax credit. And what's going to happen throughout this conversation is you're going to see my ears perk up, my tail starts to wag a little faster. I get very excited about this because this is a little known, underappreciated program in childcare. And it's amazing to me how few people know about it. In fact, you know, we've been one of the few organizations really pushing it. I'm speaking at Build next week on it. At their conference. This is not something that's well known. In the for-profit world, especially among larger small businesses, they all know about this and they're cashing in on it. It's a great opportunity. This is, you know, put aside employee retention and tax credit, because those are like overwhelming concepts and thoughts. Put them aside. Think about this as an easier PPP. It's payroll-based. We're going to talk about how it's payroll-based, just like the PPP, but it's easier. The refund has no constraints. There's no forgiveness. There's no application through banks. It's a lot simpler. This is for providers with W-2 employees. So this is one, unfortunately, where if you're a home-based provider, unless you have a W-2 employee, this one doesn't apply to you. But if you are that nonprofit that Melanie described, this does apply to you. So how do you do the ERTC? 3 steps. It's literally this simple. 1, you self-certify a trigger. We're going to talk about what those triggers are in a minute. But you see, if you know 1 or more, just has to at least be 1 of those triggers apply to you, then you're eligible. The way you self-certify that is you of course follow the rules and you write yourself an old school memo to yourself. You don't have to apply. There's no application form. People have said, can you send the link to us? There's no link. This is entirely self-documented. Then you alert the IRS. Now we were just talking about the 941 and how that works, your quarterly filings. Same. There's a line now on the 941 and the 941X, if you want to change it going back to 2020, that says total employee retention tax credit. You send that into the federal government. It is now considered to be an overpayment, is essentially the mechanism they're using on your employer taxes. Again, if you're a nonprofit, you're still paying Social Security. It's only one nonprofit we've worked on where that hasn't happened, and that was because they were not doing what they were supposed to be doing. So that's a whole nother story. So, for most of you, the overwhelming majority of you, if you have W-2 employees, you're doing this document. So you send it to the IRS. It takes about 8 to 10 weeks. This is not fast because a lot of other for-profits are taking advantage of it in particular, but then you receive a check. And again, rainbow colored IRS check. No constraints. If you notice, there's no forgiveness. There's no caveats on here's what you can spend it on. That's it. I mean, let's talk a little bit more about those triggers because these are really important. And then I'm going to talk more about the amount of money involved. So 3 triggers. This is the hardest part of the ERTC. It's probably the hardest part of today, right? 1, closure. All of these things have to be because of COVID order, either state, local, national. It has to be because of instructions you were getting from a government agency related to COVID. So unfortunately, if you had to close because of the winter storm, doesn't count, unfortunately. But if you had to close because of government order related to COVID, does count. And the closure in this case would be that period. So let's say from March to April 2020, you were closed because the city government told you couldn't operate. That period would count. Now, second trigger, hardest one. This is like we're at the top here. Everything's downhill after this one. So this is about revenue reduction. So what you have to remember is this. 2019 is always our base, right? So that's our base year. 2019, before the world ended, is the number we're always comparing to. And we do this by quarter. So calendar quarter, right? So January, February, March, April, May, June is quarter 2, right? So you take your revenue, gross revenue. So anticipating the nonprofit question, again, going back to Melanie's point earlier, this is your gross revenue. It's everything you took in, right? The only thing you cannot count for this, or you can put aside, is PPP. If you got a PPP, put it aside, right? And you're comparing your revenue from 2019 first to 2020 by quarter, and then to 2021. In 2020, what we're looking for is a 50% or more reduction. So if, let's say, because I'm very simple, you made $100,000 in quarter 2, 2019, and then in quarter 2 of 2020, you made $49,000. Well, that's a 51% reduction. So you would be triggered, right? So that's 2020. And once you trigger it, by the way, it has to now go above a 20% reduction. So if we take that example, we triggered in quarter 2, and then let's say quarter 3, we did better, right? We made $75,000, and in 2019, we made $100,000. Well, that's still a 25% reduction. That's more than 20%. So now we can go to quarter 4, et cetera. So you can see where this continues once triggered. In 2021, it gets better because now we're just looking for 20% reduction, which makes it a lot easier to qualify. And again, same rules. Once you trigger it, you at least get 1 quarter to recover. And if you don't, then it keeps going and going and going. This can continue through the end of the calendar year. So you have basically from quarter 2, 2020 through the end of this calendar year, that's up for grabs if you qualify. The last trigger is what we call partial cessation of business. And this is one I didn't talk about. Like if you go back to some of the times I spoke about this at state level, nationally, last winter, I wasn't talking about partial cessation of business because we didn't have a definition of it. And so it made me very nervous to say to people, well, the definition is the IRS will know it when they see it, which is not what you want to hear. But the IRS helped us out thanks to the accounting industry really pressuring them in March 2021. And what they said was partial cessation of business is when you have a 10% or greater reduction in the capacity to produce goods or services in total or as a business unit. So what does this mean, right? So the example the IRS gives, which is a great one, is a restaurant. Restaurant has a takeout service, it has a table service. During COVID, the takeout service did really well. Was there some diminishment of their ability to work because of the masks and Other protocols, yeah, but could you really say it was 10% or more? Like they were doing 10% or more or greater reduction in their work? Be hard to quantify, right? What about the tables, right? Well, those are easier, right? They had 10 tables in that dining room, and then they had to wheel out 4 of them because they had to separate the other 6, right? So that's a 40% reduction in their capacity. Keep in mind, it's not about who sat at the table for lunch. It's not about who was lined up at the door or not. It was about how many tables they had. The way this translates to childcare is very similar, right? In that if you can document, for example, that you had, like one provider we worked with, we had 60 kids licensed capacity in 2019 before COVID hit. And then let's say in early 2021, we only had 40 because we had to do some social distancing. The Board of Health came in, didn't want us in this classroom or that classroom. So we can only accommodate 40 kids. Now we only might have had 15. That's not the point. We're looking at capacity. So in this case, we were allowed 60 before COVID. We're only allowed 40 in COVID, right? That's a 33% reduction. That triggers this. The reason why I say business unit is the IRS is trying to be very careful. If you're, let's say, a small center, and it's just like you in 3 classrooms, and the director pitches in as a substitute a lot, you all know who I'm talking about, right? This could cover your entire operation. If, let's say, on the other end of it, if we look at a YMCA we worked with, this qualified for childcare, the gym, and their after-school program. But like the headquarters unit, the central administrative office for this larger Y, we didn't include because, again, it was kind of like the takeout example. Was there diminishment? There was, but not as clear. So I think Melanie has a question before I continue. Did I get it right, Melanie? Do you have one?
Yes, thank you, thank you. So a couple great questions have come in through the chat box. If providers access these funds, do they count as income or credit?
So yes, and I'm assuming we're talking about all of them or just this particular one?
If you can address all of them, that would be great.
Sure, I'll be happy to. Let's go backwards, right? Employee retention tax credit, we haven't even talked about the amounts, but we will, counts as income. Families First counts as income, right? If you go to the relief fund, that's a reimbursement. That gets a little bit trickier. So if, like, for example, we had a provider who is looking at buying something in August, right? They want to replace a van. Okay. So they're going to make that purchase. The price of that purchase is going to be offset by the dollars they took in through that reimbursement. So there shouldn't be a big impact on their taxes. Now, if you're going historically and you say, I already paid for all my payroll January 2021, and now I'm going to use this to pay for it, yes, you're going to end up with some extra money. And that is taxable. Yes.
Great. Okay. And then can you clarify if a provider has received PPP funds, what impact does it have on all of these as far as, you know, what are you allowed to apply for? What can you not? Can you just clarify that for us?
Great segue. I mean, you know, into, and I'll take it from here with the ERTC, but let's go back, right? Relief fund, great question. You cannot use anything you reimbursed with PPP or paid for with PPP cannot be reimbursed through the ERTC. So if we paid for Melanie's time through the PPP in March 2021, we can't then bill her to the relief fund. That's the one exception, right? For how you can, you know, attribute costs. Same thing goes for Families First, right? If Melanie is on, picking on you, Melanie, I'm sorry. If Melanie is on Families First leave for a given day, we can't then charge her to the PPP as well, right? It's got to be one or the other.
But Gary,
Families, I'm sorry, yeah.
But if Melanie was on that, but Bethany wasn't, you can still access these funds for a different employee or for a different time period.
Absolutely, absolutely, I'm getting there. And because it becomes really interesting with the ERTC in particular, because it covers much larger numbers, which we're going to talk about. ERTC, same thing. If somebody's on Families First, like if Bethany was on Families First or PPP, we couldn't then ask for a tax credit against her time. But to your point, Melanie, if Bethany is, but you're not, right? We can keep Bethany on the PPP and put you on the ERTC. And for a lot of you who have not done your forgiveness yet for the PPP, this does provide opportunities to think very strategically around how you allocate these resources. So I'll give you a key example, right? Like we had talked back in December 2020, before December 2020 or 27th, 2020, when this got enacted, I would have said to you, for the love of everything, put all your PPP on payroll if you can, because it's going to be easier to account for, et cetera, et cetera. Now what I tell people is the exact opposite. If you can qualify for the ERTC and you haven't done your forgiveness yet, which many of you have not for 2021 because it hasn't opened, put as much as you can on overhead and see how much personnel costs you can then attribute to this instead. And let's talk for a minute, because I want to make sure we talk about the amounts that we're talking about the ERTC, which is part of why I get so excited about it. Because we talked about some numbers with Families First, which are good, but not great, I think, in comparison to ERTC. And the ERTC, again, we have two rules. We have 2020, we have 2021, right? So again, you know, we're doing this alert piece right here. In 2020, you get half of the first $10,000 an employee makes, each employee, in the given time period for the whole year. So let's say we triggered it, Melanie made, we triggered it for, earlier we were talking about how we triggered it for Q2 and Q3. Let's say Melanie made $20,000 over those quarters. We would get half of the first 10,000, which would be $5,000. Let's say Bethany is part-time. She only worked $7,000 over those 2 quarters. Then we'd get half of it, $3,500. But now, just between those 2 employees, we've gotten $8,500, which would come back to us. In 2021, it becomes even better. So in 2021, you now get 70% of the first 10,000 per quarter, right? Per quarter. So if you end up, let's say, qualifying for every quarter in 2021, theoretically, you can get up to $28,000 per employee. So you could see why this gets very exciting, right? Because very quickly, you can start to accumulate these credits. So before I go into, I can go into and talk a little bit about how to get help. But Melanie, it looked like you might have another question, so I was going to pause for you.
There's several questions. I think maybe if you want to finish this, and then I'll go ahead.
Sure, sure. So getting help, there's a few ways to do it. If you go to childcare.texas.gov, we have a step-by-step guide for you. We have links to other resources. So if you go literally to the other resources section, you'll see the ERTC, you'll see information on Families First. This is all in English. There are documents, there are easy to use guides in English as well as Spanish, videos in the same as well. So if you prefer to have a video to learn things, that's there too. If you have an email question on any of these, right, email us at texas@ecebizcoach.org. And you can also request coaching. You can write these in English or Spanish, whichever you prefer. You can email us those questions. I know we'll probably get a couple of technical questions, because I know that there's been a number of different points along the way with the relief fund where people have hit technical issues. Strongly recommend, if you're going to email us something, try to take a screenshot, let us know your operation number and your user ID if you can. I know it doesn't apply to every case, but that's going to save us an email back to you saying, hey, Melanie, can you send us a screenshot? Because there are a number of different little things that we need to know to try to route it to IT in the right way. Last thing we have is we have question and answer webinars. They're 5 times a week. These are in English, these are in Spanish. You can go to childcare.texas.gov to find the times. Right now, they're focused entirely on the relief fund. Starting next week, you guys are first to know. See, here's your exclusive. We're going to start adding some of these other topics as well. So if you want to learn more about the ERTC and Families First, you'd have a much more intimate setting to ask your questions, as well as other topics related to your business, strengthening it as you go through the end of the pandemic and start re-engaging in the economy fully. So with that, Melanie,
Great, great.
have questions?
Thank
Yeah.
you. Very helpful. So there's a couple questions around if the childcare program is part of a bigger business or part of a church. Does what applies to them apply to the parent business or the church, or how does that work within the framework of a bigger organization?
For any of these,
For
right?
any of-
Okay. So if you are a childcare provider in a church, right? And this is a great question because I know a lot of you are in this situation. Relief fund applies to you. Where it gets difficult, right, is when you have some costs that might be related to the church directly and you're trying to then parse them out to the childcare business. That becomes harder. But if, let's say, like earlier today, I was exchanging some emails with a church-based childcare, and they're going to pull their portion of the payroll reports that the church has. They're just pulling their employees. Well, that works. That's fine. Families First, it works fine, right? As long as they're W-2 employees, if you're not going to have a sole proprietor in a church nonprofit, it works, right? Same mechanism as any other corporation. Employee retention tax credit. This is a real interesting opportunity if you're a church-based childcare provider. So, we've dealt with a number of church-based childcare providers that had problems accessing a second PPP, right? And what they would tell us is, gosh, Gary, I can't hit the revenue test. Not because we're not suffering, we are, but there have been so many kind and generous people who have opened up their wallets and given money to the church. And of course, the church is not sitting there on some like big pot of gold like Scrooge McDuck, right? They're giving out that money. And so the church is getting money, giving out the money. The childcare division within the church is suffering because there were fewer children. But because that revenue in, the federal government, when it determined PPP was at the organization or business level, so they couldn't qualify. If we go back to the ERTC, one of the things we talked about was how you can do it by business unit. So yes, you still have the revenue trigger issue, but let's say you hit that partial cessation of business. In particular, you could use it for the childcare unit, even though the rest of the church did very well in terms of revenue. So just a kind of interesting opportunity there.
Great, thank you. And can you also clarify for home providers, if they've had to quarantine or close because of COVID, does it work the same way, or how do home providers access those funds if they had to close?
Yeah. I mean, so with the relief fund, home providers are absolutely eligible. Again, use the same allocation, et cetera, et cetera. For Families First, it's the same thing. The only thing is you're probably doing it through your individual taxes, your Schedule C on your 1040. That's the big difference. So for example, as I mentioned, I had a provider that we worked with who accumulated $1,500 for 2020. And that was between 1 week of COVID-related quarantine. She had to shutter her business for a week because of an exposure from a child. Not trying to blame them, just saying, sorry, hope that didn't come off like those darn kids. And she also had to do homeschool with her child. And so had to close and go part-time for a period. And so those all added up. When we did the formula for Families First, she got a bit over $1,500 back. So again, this is something where Families First in particular, if you're a family care provider, I can only say that there are a handful of family care providers I've met who haven't had to have time off for COVID, time off for quarantine, or time off for remote school. So for all of you, this is a really great opportunity. And again, if you've already done your taxes, doing an amendment is fairly easy if you use online software. If you don't, 1040X, even if you do it manually, is not so bad, and we can help you with it.
Great. And Gary, when you say you can help, there's several questions with some specific questions to their case. Can the providers reach out to this Texas at ECE Biz Coach and go over their particular situations and get some help of what they would qualify for, and what is that the best way to reach out and get that support?
Yeah, the best way is email us, right, at that texas@ecebizcoach.org, and let us know what you're looking for. If it's a technical issue, I can tell you right now, it's always easier for us to do it via email. We're technically not like we're not like a tech support team. We're jumping in on this to help providers get through it. The thing that we are more adept at are those other programs like the ERTC, Families First. We can also advise on HR issues, other issues, tax issues that you may be facing. And so if you email us in, we could then triage and say, well, okay, Bethany, I can email you back and get this solved for you very quickly, or we could send it to IT and they could handle it. And we can get back to you much faster than, let's say, Melanie, who might really need to talk to somebody one-on-one about how does she pursue the employee retention tax credit or an extreme HR issue she's facing, in which case we would send you a link so you could register for a one-on-one conversation.
Great.
And all of this is free of charge. Yeah.
Are available to all providers to do those one-on-one conversations. And I would,
as long as you were licensed or registered. That's what I should caveat. Sorry.
thank you. And then if you can speak a little bit to some issues about if there's a provider that would qualify but did not receive an email, should they also reach out to that? And will you follow up with that?
That's absolutely right. Yeah. It's the easiest way to do it. So what you would do is you would say, hi, this is Melanie. Give us your operation number right up front. It's gonna make it easier, right? I didn't receive a link. What we're gonna do first is we're gonna look up that operation number on a list we have of approved providers, because it's not many times, but there are a number of providers where it got caught in their spam, right? And they didn't know, or because all of this data goes off your CCR system. Like we've had a few people who said, oh my gosh, that email is still in the CCR system. I haven't used that in a couple of years. Well, that's where they've been going, right? So you may be sitting there saying, oh, I must not be eligible. Ask us. We'd rather you ask us and we confirm it, then you are eligible. And it's in that email that you haven't used in 2 years. There's all these invitations accumulating and then you're going to miss out. So for the love of everything, email us, give us that op number if you have it. It's also your license number is what you may know it as. Ask us if you qualify. We can look it up very quickly. If we come back to you and we say you're not on the list and you say, gosh, Gary, some weird things happened right around May 1st that were unusual, and that's why I may not be on the list, we'll ask you some other questions. We'll provide it for TWC and they can review your case.
That's
but
really
ask. I'd much rather you ask and we have to tell you, no, sorry, Bethany, you don't qualify, than you miss out.
great, great. And then just timing wise, so several providers have applied for the relief grants, but it still says pending or it's approved, but they're not seeing anything. Can you talk a little bit to what the expectation should be on that, if you know?
Sure. And I know it's been frustrating, right? Like the good news is two things. One is, and I'm not just saying this because of TWC, but if you look nationally, Texas is out front on this. Nobody is moving this kind of money. The conversation I referenced yesterday in New Jersey, their stabilization funds, zero right now. They have a small up to $10,000 per provider grant program. That's it in the state. Pennsylvania, zero. Last I heard, Minnesota, zero, right? So the good news is TWC is working to try to get these funds out ahead of anyone else and get them in your hands. There's also the other good news is there's been a great response to this, which is wonderful, right? We want people accessing it. The problem is that volume has slowed things down a bit. So it may not be as fast as you want. Some of the technical issues were not expected. What I would say is, TWC again is committed to getting the money out. For those of you who have been approved, if you've requested your funds, they should be to you in a check within 21 days of that request. If it isn't, let us know. But I know TWC is moving on it. If you're in that category of like you've been approved or you've been signed and you're waiting to be approved so you can request funds, TWC is doing more and more of them every day. They do want to check through them because again, they want to make sure this is going to genuine childcare providers in the state of Texas and not make a mistake and send the money someplace it doesn't belong, right? So that's really important. If you're in that process where, let's say, some of the information in the CCR was wrong. And one of the things we're finding is a lot of people let that data sit, and that's the data that has to be used to validate who you are. So sometimes it gets frustrating because, Bethany maybe does her application. She gets to the point where she has to validate her identity and the system says, well, you're not who you say you are. Your name changed a couple of years ago and you never updated the CCR system. So now you have to go back and do it. In cases where you do have a valid issue and your application is in, TWC has assured us they will honor those applications for funding, even if it runs past the deadline. And I know you want the money, and we want you to get the money as fast as possible, but I'm just saying, don't think that if it isn't resolved by July 31st, you're totally out of luck, right? And I know we want to get you the money, again, as fast as possible, but I also want to just, again, make sure that you know it's coming. There's a real commitment to get it to you.
Great. I know we're coming short on time, Gary, but just a few more quick questions if we can.
Sure.
There's some great ones in the chat box. Can funds be used for a retention bonus or to pay back transportation due to COVID-related issues?
Let me take them backwards. The transportation one could be tricky. I'd love to hear a little bit more details as to the nature of it, right? Like, so for example, right, if let's say you tell me, Gary, I was logging just like I should for my taxes, the personal use of my vehicle for work, right? Like there was a provider I was emailing with the other day who was using her personal card to shuttle a kid, or two kids, excuse me. And she's logging her time and using the normal IRS mileage reimbursement. That's straightforward, yes. Let's say you're a company, you're a nonprofit, you have to replace that van, you're looking at it going forward, yes. Where it gets gray is like a provider who asked me, well, can I just buy a new SUV for myself? That's, well, I shouldn't say gray, that's no, right? So let's be clear. So I want to be a little cautious about the transportation one. Shoot us the details of it and we can give you an answer. What was the other question? I'm sorry.
If some of the funding can be used for retention.
Oh, retention bonus, yes. So yeah. Absolutely. What, there's a few ways that you could use it with personnel. One is you could do retention bonuses. Two, you could just do one-time bonuses. You could do temporary bumps in pay. You could do temporary bumps in pay retroactively, right? And by the way, and we have this in the step-by-step guide on the website, if you're a sole proprietor for that home-based provider where it's just you, we can also tell you how you can document paying yourself. So that can be included, because I know many of you only pay yourselves when the checking account gets to a certain point and you say, gosh, I'd really love to use that, but it hasn't gotten to that point. How do I document it, right? There's some instructions on that. And we can, again, guide you through that if needed.
Great. Thank you, Gary. Well, really appreciate this. It sounds like the best way to get some more questions answered would be to email that texas@ecebizcoach.org. And
absolutely,
like if you put in your operation number, you might get some faster response. I'm going to pick up from Gary. Gary, this has been so helpful and so appreciated. We, on behalf of the Child Care Group, Child Care Associates, Early Learning Alliance, the North Texas Early Education Alliance, Workforce Solutions of Greater Dallas, Workforce Solutions of Southeast Texas, Workforce Solutions for Tarrant County, and Workforce Solutions for Heart of Texas. We are so grateful that you took your time to share this critical information. And I want to thank all the providers for all this valuable work you do every single day for Texas's young children and families. We know how challenging this has been, how challenging it always is, but particularly how challenging it's been and how important this work is. And we hope this information and resource will be helpful in building your childcare program back and building it better. There's so much out there that's helpful. And Gary, you've shined the light on some things that we may not have known about. And this is complicated for all of us and still trying to figure out the tax forms and this fund and that fund. We also do think there was one more question in the chat box asking about future funds. There is more money coming to Texas. And we think if, TWC can figure out how to do the grants this way, and if providers access them, I think that there will be more relief grants coming this sort of way. They're still trying to figure out the details on it. So it is just critical to connect to these sites. Gary, you guys are providing an invaluable service because it is complicated, and making it available the way you have is just wonderful, and we really appreciate it. So thank you all for attending. Thank you for being with us today. Please do reach out to that website to look at the childcare.texas.gov website and to that email. Use these resources, and Bethany from ELA and I are very available to help keeping you connected and getting this information, because you all certainly deserve as much support as you can get, and we all want to be a part of helping you get there. So thank you all for being here today.